Imagine a room, no phones allowed, thick, soundproof walls, armed guards outside. Inside, 12 people are sitting around a mahogany table, staring at a projector screen. They aren't planning a war, or a heist, or the next season of The Bachelor. They are doing something much more dangerous. They are deciding the price of money. With a simple show of hands, these 12 people can crash the stock market, make your credit card bill explode, or inadvertently cause a recession that leaves millions unemployed. They are the Federal Open Market Committee, the FOMC, and the gray-haired guy at the head of the table, he's basically the wizard behind the curtain of the entire global economy. Welcome to the wild, slightly terrifying world of the Federal Reserve. You hear about them on the news constantly. The Fed cut rates. The Fed hiked rates. Jerome Powell sneezed and the S&P 500 dropped 2%. But what actually is this place? Is it a government agency? A private bank? A secret cabal of lizards? The answer is, complicated. To understand why everyone on Wall Street holds their breath every time these guys have a meeting, we have to go back. Back before credit scores, before crypto, to a time when the US banking system was basically the Wild West run by guys with monocles. New York City, 1907. The economy is melting down. Banks are collapsing like dominoes. There is no Federal Reserve to save them. There is just one man, J.P. Morgan, the actual guy, not the bank. He literally locks the country's richest bankers in his library, locks the door, and refuses to let them leave until they pool their money to save the economy. It worked. But the government realized, hey, maybe our national financial survival shouldn't depend on whether one grumpy billionaire is in a good mood. They needed a system, a central bank. But Americans hated central banks. They didn't trust Washington with their money. So, in 1910, a group of politicians and bankers boarded a private train car with the shades drawn. They traveled to a secluded resort on Jekyll Island, Georgia. They used code names. They went duck hunting. And in between shooting ducks, they wrote the blueprint for the Federal Reserve. When it launched in 1913, it was designed to be a Frankenstein's monster. Part government, so it serves the public, and part private corporation. So politicians can't just print money to buy votes. It is the bank for banks, the lender of last resort, the plumber who fixes the pipes when the economy gets clogged. Fast forward to today. The Fed has two jobs. Two, that's it. It's called the dual mandate. Job number one, keep prices stable, fight inflation. Job number two, keep people employed. Sounds easy, right? Wrong. Because these two things usually hate each other. If you stimulate the economy to create jobs, prices go up, inflation. If you crush inflation, businesses stop hiring and people lose jobs. The Fed is basically trying to drive a car at 100 miles per hour while balancing a glass of water on the dashboard. And their only tool to drive this car? The federal funds rate. This is the big word everyone freaks out about, the rate. Let's explain it simply. Imagine the economy is a party. When the party is lame, nobody is spending money, businesses are closing, the Fed wants to spike the punch. They cut interest rates. This makes borrowing money cheap. Suddenly, buying a house is cheaper. Starting a business is cheaper. Buying a Peloton on credit is cheaper. Money floods into the system. The party gets wild. Everyone is happy. Stocks go up. But then, the party gets too wild. Too much money chasing too few goods. That's inflation. Suddenly, your $5 latte is $12. Used cars cost more than new cars. This is when the Fed has to be the buzzkill. They walk into the party, turn on the lights, and smash the punch bowl. They hike interest rates. Now borrowing money is expensive. Your credit card APR goes up. Mortgages get pricey. Companies stop borrowing to expand. People stop spending. The economy slows down. Inflation cools off. But if they hike rates too high or too fast, whoops, you just caused a recession. The music stops and everyone is crying. This brings us to the FOMC, the Federal Open Market Committee. It's made up of the 7 members of the Fed Board of Governors, plus 5 of the 12 regional Fed bank presidents. They meet 8 times a year in that secret room in DC. They look at charts, drink terrible coffee, and argue about whether the economy is too hot, inflation, or too cold, recession. And at the head of the table sits the Fed chair. Currently, that's Jerome Powell, or as the internet calls him, J-Pow. Being Fed chair is arguably the most stressful job on earth. You are not elected by the people. You can't be fired by the president. Well, it's complicated, but mostly no. You serve a term, and your words move markets more than any army. If the president says, the economy is good, nobody cares. If the Fed chair says, I'm slightly concerned, trillions of dollars can vanish in seconds. History is littered with Fed chairs who became villains. Take the 1970s. Inflation was out of control. 14% a year. The economy was a disaster. Enter Paul Volcker. Volcker was a giant cigar-smoking economist who didn't care if you liked him. He decided to kill inflation by any means necessary. He jacked interest rates up to 20%. 20%. Imagine paying 20% interest on your mortgage. The economy slammed into a brick wall. Farmers drove tractors to DC and blockaded the Fed building. People sent him car keys because they couldn't afford their payments. But it worked. He broke the back of inflation. He caused a recession to save the dollar. He was the doctor who broke your leg to reset the bone. Then came the modern era. 2008, the housing crash. The banks gambled everything and lost. The entire global financial system was days away from total collapse. The Fed, under Ben Bernanke, did something unprecedented. They didn't just cut rates to zero. They started quantitative easing. Big word alert. Here's what it means. The Fed essentially opened a laptop, typed a bunch of zeros into a spreadsheet, created money out of thin air, and used it to buy bonds from banks. They injected trillions of dollars into the veins of the economy. They printed their way out of the apocalypse. And they did it again in 2020. When the world locked down, the Fed chair, Jerome Powell, looked at the abyss and said, "Not today." The Fed printed roughly 40% of all US dollars in existence in just a couple of years. The money printer went. It saved the economy from a depression, but it left us with a massive hangover, inflation. Which brings us to right now, and why rate cuts are the only thing your finance friend talks about at brunch. For the last few years, the Fed has been hiking rates frantically to fight that post-COVID inflation. They've been slamming the brakes. But now, inflation is coming down. And everyone is asking the terrified question, did they hit the brakes too hard? If they keep rates high for too long, businesses will suffocate and we get a recession. If they cut rates too early, inflation might roar back like a zombie you didn't double tap. This is the soft landing. It's the economic equivalent of landing a 747 on a tightrope during a hurricane. That is why rate cuts are big news. A rate cut is the Fed saying, okay, the war on inflation is won. We can relax. Go buy things again. It signals that the emergency is over. It usually makes the stock market skyrocket because investors love cheap money like cookies loves milk. But there is a catch. Sometimes the Fed cuts rates not because they won, but because something just broke. If the economy starts tanking, they panic cut rates to save the ship. So when you hear rate cuts coming, you have to ask, are they cutting because we're healthy or because we're dying? It's a game of psychology. The Fed's greatest weapon isn't actually interest rates. It's forward guidance. That's a fancy way of saying talking. The Fed chair will go on TV and say, we expect to keep rates high for some time. He might be bluffing, but because he said it, banks get scared and raise rates on their own. He literally manipulates reality with his voice. It's Jedi mind tricks for bankers. So here we are, the entire global economy, your job, your 401k, the price of your groceries, it all hinges on 12 people in a conference room in DC, trying to read the future from a stack of PDFs. They are the unsung, unelected kings of capitalism. They control the gas and the brakes of the greatest economic engine in history. And the scariest part, they are just guessing. They have better data than us, sure, but they are still just guessing. So next time you see FOMC meeting trending on Twitter, or you see a video of a gray-haired man in a suit mumbling about basis points, pay attention. He's not just talking about numbers. He's deciding whether you're going to be able to afford a house next year, or if you should start stocking up on canned beans. The money is made up. The points don't matter. But the guy controlling the printer, he matters a lot. And right now, his finger is hovering over the button.